Welcome, ladies and gentlemen, to our regular 6-minute strategy summary. For global investors, this quarter has been all about facing up to a reality that most of us had long suspected, namely that taming wage growth and squeezing inflation, especially in the service sector, will still be a difficult and drawn-out process. Despite one of the sharpest interest rate tightening cycles in 40 years, core consumer prices are still stubbornly high. In the US, they remain at more than twice the central bank's 2% target, while in the UK it's more than 3 times. Yes, central banks may not raise rates much further, but they are still away from cutting them. This realization has delivered a tough quarter for investors. Equity markets have fallen by about 4%, led by the technology-rich Nasdaq, while bond yields have soared, rising by 75 basis points in the US to 4.6% for a 10-year bond, the highest since 2007. To complicate matters further, oil prices too have risen, climbing 24% over the quarter on extended Russian and Saudi cuts, jeopardizing, of course, some of the hard-fought falls in inflation that we have seen. We will look at how investors can respond and what changes in asset allocation might be required in the slides ahead. So let's look at world markets for the year to date as we normally do. That dark blue line, global equities up 9% for the year to date, but off quite sharply over the quarter, 4 or 5% as I mentioned earlier. UK gilts performing much worse, but actually flat on the quarter. That was much better than most other world bond markets, a particularly notable sell-off in US Treasuries. On the right-hand panel, we always look at the S&P 500 and the index without 7 members. That's the Magnificent 7, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla, the so-called AI-driven supercaps. Now, the index with them in is up 11. The index without them in, the other 493 members, actually flat for the year. I've never seen divergence like that, and it does get me a little bit worried about technology valuations. So what's behind the decline? Well, first of all, we saw an aggressive rise in the dollar. Unexpected and probably unwelcome. It has 2 effects. One is to push up prices of dollar goods outside of the US, that's inflationary. And secondly, it tends to tighten liquidity in the emerging world, which can prove problematic. The second factor was a 24% increase in oil prices. Again unexpected, as Saudi Arabia and Russia extended their synchronized cuts in production. I think they're targeting somewhere around $100, and this is going to have a real effect on some of these hard-won inflationary gains we've seen. Thirdly and finally, just back to technology valuations again, just to remind you, the US tech sector is trading on 40 times historic earnings and 8 times book value. Those are very high numbers and could, in my view, continue to come down to earth and was certainly a factor in the tech sell-off this quarter. The most important factor, though, probably in my judgment, was that central banks have indicated they're going to hold rates at these high levels for longer. Perhaps not many more rate rises, but certainly a more of a flatlining of rates at restrictive levels. Now, why is this important? Well, I've looked at US interest rates, the so-called Fed funds rate, back to 1970 in the chart below, and shown their performance peaks and troughs in relation to the recessions of the US economy in grey. And you see, using Hugh Pill, the Bank of England's chief economist, his analogy, they look principally like Matterhorns, a steep rise up and then a very sharp fall as central banks cut into a recession. What we're looking at this time, he said, is something more like Table Mountain, up quite sharply and then flat for some time. Now, we've put our dotted line in there, which is the estimate of our trajectory. And you can see it's a very different profile from the typical tightening and loosening cycle. And I think this is important, and it puts quite a lot of pressure on bond markets. And yes, you can see it here on the left-hand panel, the next side of the left-hand panel, that sharp upward move in UST bond yields. You're now getting 4.6% off a US 10-year Treasury. That's the highest since 2007. UK bonds rising, you're nearly getting 6% now on UK corporate issue, beginning to get attractive. The rise has also really hit hard inflation-linked, or what we call the US chips, pushing up the real yield you now get on a 20-year US chip to 2.2%. That's attractive because you get that regardless of the inflationary outcome. Is there any changes in the US economy behind all of this? I don't think so. I think a soft landing is still on the cards. The US ISM services we've looked at before, anything above 50 expansion at 54.5, that shows some growth. On the right-hand panel, you can see job openings beginning to fall, still well above pre-COVID levels, and wages easing now to 5.3%, still much higher than central bankers would like. I'm though a little worried about the strike by the United Auto Workers Union against Ford, GM and Stellantis. They're asking for a 36% wage increase over 4 years, and this could possibly show contagion across other industries. And there's Biden up on the top right on the picket line. So what does this mean briefly for policy summary? Well, we're wanting to move overweight in bonds, but waiting just a little longer till some of this volatility subsides. Buying some corporate bonds here in the UK, but waiting just a little longer to move on the inflation-linked bond market in the US and UK. Equities are underweight. Yes, we can be nearer neutral if we have portfolio insurance. We're just cautious about those valuations and the impact of oil. Our alternatives at neutral, particularly overweight still to gold, carbon and climate and transition metals, gold particularly against a failure summer in the financial system as rates rise. And cash overweight, we're sitting there earning very good money on interest, and it's a good tactical position. So to wrap it all up, I think you see our position. We're ready to move into bonds and interest rate sensitives, waiting just a little bit longer. We're cautious on equities, we see some valuation compression, and we just want markets to digest this new forecast for central bank interest rates before we move. Well, I hope that's helpful. Thank you.